first idea is CAE. We could be running into major pilot shortages in years to come.
Yeah, so with regards to CAE, it's funny because I've been, for the past hour talking about my love for dividends and how much I appreciate them. And here I am, my top pick. My first one is a stock without a yield. It did pay a dividend up until the pandemic in 2020, which then they had to eliminate it, just considering what happened in the airline industry during the pandemic. We do think they will reinstate their dividend, and it could be as quick as this year. But this for us is a no-brainer in terms of a good long-term investment. So there is a pilot shortage. I think there's an estimate that we need 264,000 new pilots by 2029. All of those pilots are going to need training and flight simulation, and not just the pilots, but also, any of the cabin crew and the flight safety and all of that. And, we're seeing flight safety being, one of the top headlines right now. CAE provides, and they're the biggest flight simulator and flight training facility in the world. And so there's going to be demand for their products for years to come. If you think about a pilot that graduated from pilot school, they're not just graduating and then flying a 747. They're gonna start with a regional jet or a smaller plane, and then they're gonna work their way up. And every time they work their way up another level, that is several more hundreds of hours of training that goes involved with that. So not only are we gonna see, a need for new pilots, but those pilots need to work their way up, and that's just a continuous stream of income for CAE. The second part about CAE that we like so much is that recently their defense margins have been very low, and the way the stock is priced in right now is you're essentially getting the defense segment for free. We haven't seen, prior to the past few years, we haven't seen a war in a long time. There hasn't really been that much defense spending, but I think we are going through a time right now that things feel a little bit more unstable on the geopolitical side. So should any of these geopolitical risks that we're seeing right now come to fruition, I think it's not a bad thing to have some free exposure to the defense side through CAE's defense segment, and they do training for defense and for Army and military training.
Your next idea, Brookfield Infrastructure Partners.
Yeah, so Brookfield Infrastructure Partners, it falls in the utility space, but I would say only a third of their business is actually utilities. I would really call Brookfield Infrastructure a private equity firm that invests in any kind of essential infrastructure businesses that are required, and they're also geographically diverse. So think, toll roads, think airplanes and rails, and they also do a lot of utilities and natural gas. Like they have big exposure to, they bought Enercare's assets a few years ago, and that should continue to do well, with furnace rentals and things like that. And so that stock, I don't understand it. It was off 42% last year from peak to trough, and there was no news coming out of the company. I just think it was, negative sentiment. They are a more leveraged name. They do focus on what's called capital recycling. So they buy, assets at undervalued levels, then they operate it, they extract the value, and then they sell it at a premium valuation. And they need to be able to continue to capital or recycle that capital to sell assets to be able to fund their growth. So I think the question was, are they going to be able to keep doing that and selling at a premium? They have been one of the best operators in the space. We have faith in the management team to continue to do that. And they also, compared to, let's just say, traditional Canadian utility, their targets are basically infinite in terms of what they could buy. They could buy, any kind of asset in any jurisdiction in the world. So they have a lot more opportunity, and they also have access of capital through Brookfield's parent corp. So for those reasons, we just think, Brookfield, we don't really love the buy and sell, nature of the business, but if you're going to own one, it's going to be Brookfield Infrastructure because they're the best at it.
And then finally, we touched on this before, but Emera. Over the years, Emera has not been such a fast grower as Fortis, if I remember correctly.
They're kind of neck and neck, with regards to their rate-based growth and dividend growth. There was a period of time where Emera's dividend growth was actually faster than Fortis's, but then they ended up having to scale it back because their payout ratio went too high. So
that's what I'm thinking of, maybe. Yeah, sorry. Go on. Yeah.
So, Emera is not the same company it was 5 to 10 years ago. They have more assets in the U.S. now than they have in Canada. They did a large acquisition several years ago called Tico Energy, where they bought, most of their assets are now located in Florida. If you think about the pandemic, now Florida has the highest population growth of any state in the U.S. So just on population growth alone, Emera is able to increase their rate base. And like we said, Florida is a very good jurisdiction in terms of rate increases. They're also very diversified. They have, assets in several different jurisdictions. So with interest rates, going up, as their rate base cases come to fruition, they're going to be able to ask for higher rates and get paid higher ROEs on the different jurisdictions. So I think they're targeting 7% rate base growth through 2026. Their dividend growth should be 4 to 5%. Again, they're very defensive, and we think that this is a name you want to own for the long term.
And investors missing value generally in these utility stocks, you think?
I think there's a huge opportunity, and the stock, I think, is trading at a very low valuation. Emera is a lot cheaper than Fortis. Fortis has always had that premium valuation. Emera a little bit cheaper, but we think that there's an opportunity for Emera to catch up.
Rebecca, great debut, and thank you very much indeed.
Thank you so
At least
much.
one person on Twitter I see singing your praises. So I hope you come back soon.
I swear it wasn't my mother.
No. Thank you very much. Rebecca Telcher of New Haven Asset Management. First idea, Tourmaline Oil.
That's right, Andrew. This is Canada's largest natural gas producer. Produces about 2.3 billion cubic feet a day of natural gas. It's almost 15% of all the natural gas produced in this country. Wow. And then on top of that, another 100,000 barrels a day or so of oil and natural gas liquids. It's a lean, low-cost, good scale operator. So despite warm weather keeping nat gas prices fairly low this winter, this company is resilient enough to be profitable through the cycle. That's partly operating efficiently, but it's also smart marketing. So they don't just sell their gas at the AECO hub in Alberta, they move it to the West Coast, and they've even struck a deal with Cheniere Energy to ship it down to the Gulf Coast where it gets exported to Asia, and so the prices that are sometimes 10 times higher. We like the balance of capital discipline and growth. They have actually returned, through a combination of regular and special dividends, $6.55 to shareholders over the last year. And that actually equates to a 12% dividend yield on the current stock price. The game changer here is LNG Canada. The $40 billion export terminal is going to be open by next summer on the West Coast, which should create structurally stronger demand for Western Canadian nat gas. So we've owned this for a long time. I like it, continue to own it and add to it here.
We're tight for time. Home Depot is your next idea.
So this one needs even less introduction. It's obviously the ubiquitous home improvement retailer. It serves pro and do-it-yourselfers. It's also getting into adjacent markets in the repair, maintenance, and operations market for replenishment goods. So, selling to hospitals, multi-family residential landlords, government institutions, prisons, that sort of thing, which is less cyclical. They're stepping up their game in e-commerce and omni-channel capabilities. And they're also trying to get better at getting after their fair market share of the complex multi-trade projects. And that way, not only take share from the primary rival, Lowe's, but also from lumber yards and HVAC and plumbing supply stores and other sort of specialty operators. The earnings and the dividend have compounded at 16% over the last decade. The stock even better than that. So we added this to our dividend growers mandate recently. Timely entry point, undemanding valuation, still 15-16% off the 2021 peaks, and facing easy earnings comparisons in the coming year.
And then your final idea, a famous name in insurance, Marsh & McLennan.
That's right. So this is a broker of insurance and reinsurance, which is to say they are acting as an agent placing policies on behalf of clients with the underwriters. So a hard insurance market advantages them. That's to say premiums are rising. As a broker, they get a percentage of the premium. So when premiums go up, their commissions go up, and they operate those businesses through their namesake Marsh segment and their Guy and Carpenter segment. And then on the other side of the business, it's a collection of consulting businesses, Mercer, Oliver Wyman in pension, retirement, group benefits. It's a play on global employment, which is strong. This is a company that's also self-helping with a big margin uplift story that's quadrupled their ROE. So we bought this also recently and added it to our dividend growers mandate and expect to see good double-digit total shareholder returns over the cycle on this name.
Brian, thank you very much indeed.
Great to be here. Thanks for having me, Andrew.
Brian Madden.
Welcome back to Market Call, and now it's time for Gordon Reid's top picks. So let's get right into it. Your first name here that you've chosen is Adobe. What was behind this name?
Well, Adobe, most people know because of Photoshop, for example, or maybe we do PDF documents. Those are Adobe. It's really a company that is benefiting from artificial intelligence, the application, not the hardware, but the actual application. So if you think of Photoshop and being able to produce something with artificial intelligence through a product called Firefly, they're able to very quickly and very efficiently on a commercial level create a product that is vastly superior to what you could before you had artificial intelligence, and that is very commercially viable. So we particularly like Adobe. They're growing well. Their runway of earnings growth is very good. We bought it about a year ago at about $320 a share, and it's obviously done extremely well for our clients. But it's a top pick today because I continue to like it very much. The multiple has crept up a little bit, but it's really not of great concern because of the likelihood of rapid runway growth in revenues, earnings, and cash flow. So we're very strong on Adobe.
Okay, yeah, it is a name we all know. This next one may not be, though, Lennar. It's in the home building sector. Why did you choose this one?
Yeah, we own about, I think it's 5 U.S. home builders in our U.S. small cap portfolio. Lennar is one of them. They've all done extremely well, and there's a few reasons why. One is that in a low interest rate environment, mortgages are more accessible. Home builders do well, they sell more homes. But the underlying reason that home builders are doing well is that there's been an undersupply of homes available for a couple of decades. And we know that in Canada, but it's also the case in the United States. You have to have household formations north of 1.5 million per year to really just keep up, to stay even with population growth, which is organic growth of people in the United States, plus immigration. And we're barely touching that. So there's a shortage of homes, and the home builders have gotten much more efficient managing their businesses. They used to build sort of on spec, they called it, on speculation. Now they build to spec. So they're not stuck with these huge developments of inventory when cycles turn. And they're very efficient in how they buy land and how they develop it. They trade at less than 10 times earnings generally. Lennar is about 9.5 times earnings, yet it grows in the low teens in terms of growth of earnings. So we're particularly high on all of the home builders, and I thought I'd profile Lennar today.
Okay, and last but not least, your final name here is U.S. Food Service. Why did you choose this one?
This is a new entrant to our U.S. small cap portfolio. Again, I've talked about peer group analysis, and one of the companies that we've often looked at and talked about is the biggest food distribution company in the United States. And many of our viewers would be familiar with, and that's Sysco, S-Y-S-C-O. And I followed Sysco for some time, and doing peer group analysis, I run across U.S. Food Services. When I compare the two, what I see is in U.S. Food Services a company that's growing more rapidly than Sysco, yet on a valuation basis, it's priced less expensively. So that's a great combination. So we looked at this for some time and decided to buy it on behalf of our clients. We think it's particularly compelling in a strong economic situation. And we just saw the other day with the economic numbers on the employment situation in the United States. The U.S. economy is quite strong, and that's going to play right into a company like U.S. Food Services doing well because, of course, they supply food to commercial enterprises such as restaurants and hospitality operations.
Might there be any concern there with more people pulling back from eating out these days, just given the high cost of everything?
That's a great question. And when I asked the same question, Tara, what I saw was that their organic growth is actually a couple of times the GDP in the U.S. And that means to me that they're really not being held up by the numbers of people. They're expanding their businesses quite well.
Okay, sorry to have to cut you there. That was Gordon Reid. We've had a great show with him today. Thank you so much for watching.
Greg's first idea is, well, it's going to be interesting to see how this one works because it has been out of favor, relatively speaking.
Oh, it has, yeah.
Intel.
Yes, it has. Well, trying to find things that are fresh, that are under-owned. They did have a nice beat, both in the top and bottom line, but they did issue weak Q1 guidance on Mobileye, which is their programmable chip unit. Otherwise, the core earnings did look really good. They are cutting. They're cutting $3 billion in cost. They cut $3 billion in costs last year, and that does continue. Interesting that Pat Gelsinger, the CEO, did buy on this most recent dip. This is a name that you're going to be. I'm not sure it's a 1 year. It's a 1 year time horizon, but I think it really works more 2-3 years. It's reasonably priced, 19.5 times, 41% growth rate, lots of capex spending, really a play on North American reshoring and building, and so some of those things have got to work, on budget, on time. But I think it's a very well-run company, and I think that you want to buy great companies like this when they're kind of down.
Okay. Freeport-McMoRan, the copper giant.
So, copper supply is very challenged. You've seen what happened with Cobre Panama, and Anglo American as well. 2.4% of global supply is off. Inventories are down to 4 days supply. We think that copper is needed for this decarbonization cycle. Could be a takeover target, as we were talking about before. They beat on Q4. This is the world's largest copper miner. Their guidance, 3-year guidance, which is important, was in line, and Grasberg was reaffirmed. And
biggest U.S. copper producer, I think. The Chileans would be bigger, I guess.
Let me look at that.
Okay,
let me look at
yeah,
that.
Yep.
I think in terms of pure metal plays, yeah, some of them are bigger, but pure copper,
Okay.
I think I might be right there, but I'm going to look into it. But we do model 20% earnings per share growth, trading at 19 times with a strong balance sheet. Like it.
Okay. And finally, Uber. Well, Uber delighting investors with its latest results.
Yeah, listen, their beat was, I think, last night, 1% above street, both on the top and bottom. They're saying that a healthy economy it means more folks are doing ride sharing, Ubers, home delivery. Mobility was up 29%, delivery was up 19%. Great combination of scale, growth, in ramping profitability. It kind of reminds me of Facebook in its earlier days in terms of the combination of growth. Trades at a reasonable 35 times for 42% earnings per share growth rate anticipated. I think that this is a name that its time has finally come. It was unprofitable for a very, very, very long time. I think its issuance price was around 70. Maybe in 2017, 2018, people got very excited and, got washed out, went way, way down, and a lot of people gave up on it. I think it's a ubiquitous name, like a Facebook, like a Meta. I'm going to take an Uber. You know, it's like
Yeah,
it's like Kleenex.
In the language, yep.
So I think that we're in the early days of a lot of profitability.
That's interesting, yeah. I mean, it slid early in the pandemic, but then came roaring back in fairly short order, yeah.
Yeah, well, you know, when they came out on their earnings, and I think they issued, as I say, at 70, I mean, there was a lot of euphoria. It was all future speculative earnings, and they weren't profitable. So it was very hard for people to model what it should trade at. And, you know, they've had regulatory issues with some cities pushing back with taxis and that sort of thing. But it's a big enough world for everybody.
Yeah. I'm showing an IPO price of 45, but of course it's been up and down since then. And yeah.
Well, that could be right.
Yeah.
Maybe I'm thinking of Lyft or.
Yeah. Interesting, though, how they have changed the face of cities, really.
Yeah. This is definitely a game changer in terms of the way we navigate our lives.
Greg, thank you very much indeed.
Thank you.
Let's get to the top picks. Number one, the gigantic miner, BHP.
Yeah, so a couple of things here. So attractive entry level. Obviously, the ESG overhang is causing most commodity companies to trade at inexpensive prices. Look at that. I think the miners in general are expressing negative view on Chinese commodity demand. So we're obviously chasing that thematic, and we do think that Chinese commodity demand is going to improve. Debt levels are good, attractive dividend. But what I would say is with commodities, commodity companies, miners in general, you date them, you don't own them. And when they're on sale, and we think in relative terms BHP is, you buy it and you add exposure. When they pop up, as they did last year around the $70 mark, you trim it. So this is something that we tend to trade a little bit more. But at these levels, we think it offers an attractive risk-reward profile.
You basically look for a time when people hate mining stocks.
And I think I've consistently said that with regards to the semiconductor point.
Yeah. You got to go against the grain. Okay, Royal Bank of Canada.
Yeah. So, you know, I'm generally of the view that interest rates are going to be higher for longer. I think the bank is very well capitalised. It's got an attractive dividend, and it's grown the dividend almost 8% per annum on average in the last 5 years. There's been a buyback as well that's sort of averaged around 1%. And I think that even if we get a recession or we get significant credit spikes, the company's well enough capitalised that it's going to trade through. So I think this is still a good long-term hold, and the entry level looks interesting here.
What about the overhang, though, if lots of Canadians start losing their jobs and maybe the loans start going pear-shaped, as the British say?
Yeah, so at the moment, we've got a whole bunch of baby boomers that are obviously retiring, leaving the workforce. So we actually have not seen a significant spike in unemployment. Even if we do, the Canadian central banks obviously have a choice. Do you want to crush the consumers or crush the banks? And if you look at what happened with the fallout of refinancing the US banking system and what that did globally in terms of impacts on housing, the impacts on securities, it's cheaper to recapitalise Canadians or allow for some distortion and some bankruptcies as opposed to recapitalising the banking system. So if interest rates get to a point where they become meaningful, they will be dropped in terms of consumer impact and what it does to the Canadian economy.
And then finally, Shell, global energy company. Yeah, I'm actually curious what the yield is on it now. Because
I think it's about 4.2, isn't it?
Okay.
Yeah. So a couple of different points. So again, same point with regards to the ESG overhang. Don't touch it, persona non grata, so the valuation's inexpensive. But let's just look at the fundamentals. So they bought back 16.4% of shares outstanding on average for 5 years. 16.4%. I'll just say that again. Each year.
Whoa.
$2.5 billion this quarter, probably $12 billion for the year. So if you just think about the company in terms of total return, and you think dividend plus share buybacks, you're looking at sort of a 10% total return for shareholders. If it gets a little bit more expensive, that's fine. If it declines a little bit, then just add a little bit more. That's sort of it in a nutshell. Yeah,
it's interesting. I mean, natural gas in America, near a 3-year low, but that could be temporary, of course, mild weather and massive production.
Right, so you've got but look at what we've seen in the last little while. So 2022, Russia invaded Ukraine, energy spiked dramatically, which triggered inflation, right? So the measures taken to cool inflation have cooled energy prices to some degree, and we've also seen a normalization in energy demand. But energy demand has not gone away. And you're also seeing the concept of reindustrialization of America in terms of new energy, new industries that use chemicals.
Yeah,
So,
and use natural gas as a feedstock, yeah.
correct. So you're looking fertilizers, you're talking companies want to build new facilities in the US, but the cost of natural gas has not gone down in other parts of the world. So the US's issue is much more to do with supply.
Darren, always great talking to you.
Thanks, Heather.
Darren Sisson.